Welcome to the Multifamily Management Excellence Podcast. Are you interested in learning from multifamily experts and how they achieved success? Then you have come to the right place. Your host, Mike Ballard, interviews industry experts to share their stories and advice to achieving success in the multifamily industry. Our goal is to provide you with resources and tools to increase profitability and achieve success on your own multifamily journey.
I'd like to welcome everybody to today's podcast. My name is Mike Ballard. I'm a partner in Ascent Multifamily Accounting, and I also happen to own some properties. I'm a big believer in the multifamily space, and we're excited to have our guest today, Dan Reilly, who's the founder and co-managing partner. Is that your title, actually?
I don't really have a title, so we'll take what you got.
We're owner managers. We just do it simple.
Entrepreneur, right? Investor, but
Exactly.
Principal, I think, is what we like to say. Yeah.
Principal. Yeah.
There you go.
But he makes things happen in multifamily space. We think he's got some great thoughts, insights into the management and ownership of the multifamily properties. And so we look forward to sharing that with our podcast listeners today.
Cool.
So let's start. How did you get in the business, Dan?
All right. So this is a fun little journey. So started 20 plus years ago. I was in let's call it high commission sales role. And I was getting crushed on taxes. So good income.
Tax, right? You're in tech, right?
I wasn't correct. Technology sales. I sold servers, memory, GPUs to data centers is the quickest way to say it. So was in a commission salesperson looking for passive income like everyone's looking for, right? And we just had the great financial crisis come through. So I had a pretty painful experience on my own personal home, bought a home. It decreased in value by 30+% within a few months of buying it. So I was looking for other ways to deploy capital and try to fight my way back in real estate. I'm originally from Jacksonville, Florida, and I had a couple buddies from high school and college that were doing some flips and turns there. So, and I knew the price to purchase a home in Jacksonville was quite a bit. I live in Newport Beach, so purchasing homes out here was a little different story. So
yeah, absolutely.
Flew back to Jacksonville, met up with my buddies, and basically, the place was on fire sale. They were buying places out of foreclosure for $30,000, $40,000 for a home. They would then do they were one of the first turnkey operators before
What year was this again?
Yeah, 08. This is 08, maybe 09.
Part of the crash.
I made a purchase, right? But they were basically one of the first turnkey operators of the SFR, single family rental. That term didn't exist at the time, but good friends and had a lot of trust with what they were doing. So I said, all right, it took $25,000 down, got a traditional mortgage, and they would sell you a home fully renovated with a renter in place. So the day you purchased it, you had cash flow and rents coming in. And I said, all right, well, whatever, let's give this a try. So purchased one home, worked out better than I expected, good cash flow. We had all the tax benefits. I was working on a mortgage. So basically the idea was like every time I had enough capital to purchase one, I did another. So I got to the point.
Call your buddies in Florida, say, okay, I'm
ready to do another one. And to the point where the first three, of course, I flew out, saw the place, inspected. I got to the point where I was buying them sight unseen, just like name the address, you know who I am, you know what I like, tell me where to wire the money. So I got to the point where we had 6 of those and just a great return, great experience, and everything I was looking for in terms of an investment. I can fast forward the story, got out of that as an employee, started my own business in technology, had an exit event from that business. And then I had this, crossroads. I was looking for a new career and I had this experience with the single families.
And how many single families did you have when you?
6 at that
You
time.
still just kept those 6. That was it.
That's it. And they were cash flowing. They were depreciating their mortgages. Everything was doing what they were supposed to do. And importantly, Mike, I was putting 1 hour a month into them, which was like, get the statements, ask a few questions, make sure things are working, and then moved on. So it really, from a leverage of time and effort, it was fantastic. I got to the point where we were looking to upgrade our personal home. And again, Newport Beach, very high prices. So I made the decision with my wife to liquidate that portfolio. We had a huge gain because we had bought them so cheap and, so long ago, and was able to purchase what we'd call our dream home here with the proceeds there. Then became this new topic of like, hey, I really like that passive income and that real estate portfolio thing. And started talking to some friends, and I was pretty dedicated to going to multifamily, but I was going to buy a triplex or a fourplex, play big and get into that space. And had a good friend named Greg, who was a good friend of mine while I was going through my transition. He goes, if I was in your shoes, I wouldn't do the whole triplex thing. Like I'd go to Texas or Florida and I'd take down a 100-unit building and just figure it out. You got free agency, you got some capital, you got some time, like give it a try. When he said that, I laughed. I was like, that's silly. Blackstone buys 100-unit buildings, not me.
Right.
But literally, Mike read a couple of books, listened to a couple of podcasts, had a couple of mentor conversations, and within 2 weeks, I was convinced I can do, at least medium-sized multifamily deals. And as they say, the rest is history. Went
The
down.
rest is history. So what was it like? What was that first bigger purchase?
96 units in Waco, Texas. It's student housing on the steps of Baylor University.
And
Great asset.
why Texas?
Because people buy multifamily in Texas, right? I mean, it literally there was some thesis behind it, but really we were looking everywhere for a deal, and this thing just made sense from a numbers perspective.
So when you bought it,
Yeah.
lots of other people were buying properties. What year was this?
This was 2022.
2022.
During the peak.
You're buying this first property.
Yep.
Lots of people are buying properties in 2022.
Correct.
Many people regret those purchases.
Yes. Correct.
So and there's so much when you buy your first big property that you don't know that you don't know.
Correct.
So now, fast forward 3 years, what were the mistakes that you made?
Totally. So I think the biggest mistake that we made was thinking that the property would just take care of itself, right? We did get a good basis, which in hindsight, it's almost unbelievable to think that we got a good basis at that time. To this day, we can still say, oh no, that was a good buy. And luckily we put stabilized 65% debt on it. So we made a good decision there.
Fixed rate debt, right?
Fixed rate, 5 years of fixed rate. So, from a local credit union, and we stumbled into it. I was networking like crazy, flying over the country. And there was another co-sponsor who found this thing, found the deal, got it mostly negotiated. He wasn't able to bring the debt and the equity to finish the deal. And that was really how I got brought in. So we co-sponsored.
Did he stay in the deal?
Yes, he's still in that deal with us. Yep.
So that's one of the things that so many people that are in this business don't get. I mean, a lot of people have this abundance mentality where once you have a deal in place, people are happy to share. What do you need? Can I guarantee this? Can I bring this much capital into it? And so to a lot of our audience that are smaller players, I tell you, keep your mind open about partnering with people.
Especially on the first deal or two. If you've never bought a multifamily property before, the idea that you by yourself are going to go take down a 100-unit deal and get the debt, get the equity, manage it, it's very hard to believe, right? So we swallowed our pride and had a mindset of like, let's just get into a deal. Let's just learn, right? And to this, I can tell you, I didn't get properly rewarded from a financial standpoint. If I look back on the cap table, like, I probably added a little more value than I got credit for, but that's okay, right? Because that was the launching point to the business.
I tell a lot of people that even if you don't make any money on the first deal, just by pulling up your sleeves, do it. Look, you need to make money. Don't get me wrong, but the education you get is worth so much more than
100%. I think I can't remember who wrote it, but earn to learn was what or learn to earn, right? That concept of just like get in the game. Who cares if you make dollars on your first deal? Learn the process. And then we get back to kind of like, what did we learn? That the business doesn't take care of itself. We've been through 3 property managers in 4 years. We tried to take it away from student toward market rate, realized that wasn't a great idea. Then we've converted it back to full student. So we've made some operational snafus on that deal. But luckily, incredible location, really good structure, an 86 build. It's a really pretty building. And it literally touches Baylor's campus, which is one of the more well-funded and higher growing universities. So we've been saved by the market and the location, the quality of the building, even with some operational mistakes we've made along the way.
Great, great. So now let's fast forward to today. Tell me about what's your company today?
Yep. So Measured Capital, and I would say we're a boutique sponsor of multifamily real estate investments. Partner with high income earners and family offices to deploy capital. And we have a very specific thesis. So after that 96 unit in Baylor, 6 months, that's all we did. We just thought about that and figuring out the mechanics of that deal. But all along, we were like, we need a thesis to grow. We wanted to make the business our full-time job, right? We didn't want it to be a sideshow. So by the way, the guy, Greg, who challenged me that day, he's the co-founder and my partner in Measured. So the two of us are still, we are Measured. So we had a couple of sides, did a lot of data digging and a lot of talking to different folks, and came to find out that Jacksonville, Florida, where I'm from, and Des Moines, Iowa, where Greg's from, are on the hot list of like highest growth cities, most dynamic economies, highest income growth, great price to rent ratios. So a lot of things were working well. And it was just like, well, I know people in Jacksonville and I like that place. You know people in Des Moines and you like going there. Let's buy 1,000 units in both markets. We said that 3.5 years ago. Let's buy 1,000 units in Des Moines and 1,000 units in Jacksonville. To this day, that is what we're doing, Mike. We're at 650 in Des Moines and 250 in Jacksonville, and still highly focused on buying 50 to 150 1980s plus garden style communities in those two markets. And that's our full focus.
Great. And what's the range of unit size?
50 to 1. Let's see, we own as small as a 32, which in hindsight, I probably would like to keep it above 50. And then our biggest asset is 120.
Great. Perfect. Thank you very much.
Yeah.
So you kind of hinted about a few things. What's been the hardest part of building the business so far?
The hardest part was the timing. Apparently, we were at a peak in 2022. Hindsight's 2020. And yes, Mike, I'll say I'm very grateful to know like we're not underwater on any of our deals. We're certainly not having massive appreciation like we had hoped for. The assets have declined in inherent value because of cap rates and the interest rate cycle. But yeah, the timing has been the hardest part. When we stepped in, people were doing the value add cycle, buy a deal, do some rehab. A year later, you put it on the market, you let the next guy take it, you make a huge profit, and you cycle it back to the next one. That game stopped within 3 to 6 months of us entering the market. So rather than being in and out of these deals quickly, we're now long-term holders, and we've had to make asset management our full focus. Every day, Greg or I text each other and we say the words world-class asset management. That's what we're going for because I think it's necessary. NOI just doesn't show up. 95% occupancy doesn't just happen by random. You got to fight for it and work for it in today's environment.
So what is the key to being a good asset manager?
So, well, this is an
And
interesting topic.
you use all third-party managers today, right?
Exactly. So we'll stick within the idea of being within. We're third party only, and for now we're going to stay there, right? Of course, we're thinking potentially long term, but the phrase that we say is that a third party asset man or property manager will execute to the level you hold them accountable on the cadence upon which you hold them accountable. Without that, it's just going to go into the system, and if it goes to 80% occupied, too bad. If someone's overpaid or maintenance doesn't get fixed. It's just, if they're managing thousands of units and you have a 100-unit deal in there, it's just one thing, right? So what we found is just certainly weekly and even maybe daily, where are my leads at? What's the pipeline? What are renewal status at? The other thing is just constantly auditing bills. I mean, right now we're in a cycle of looking at dumpster charges, finding out the little tricks that a dumpster company uses to massively overcharge you and charge overages. We're looking at bulk internet, right? Not to make money on bulk internet, but to make it a feature, right? You pay Xfinity $90. Well, what if we brought it in and made it $50? That'd be a way to bring residents to us. So constantly auditing expenses and then pushing on leasing and renewals to keep the place fully occupied.
Beautiful. So how often do you talk to the management companies?
Calls weekly, emails likely daily.
Yeah. Okay. And then you've terminated a few, you said you've gone through.
Yeah.
Tell us what that process was, because you thought you picked a winner when you bought the property.
Correct.
And what happened?
I think it comes down to an alignment of values and vision and what people stand for. So it's just the idea that like where we're headed and what we're looking for to accomplish in our communities, they just weren't capable of. And when things got tough and conversations got real, it just, things weren't working out. So we've been able to go find out and interview people, new companies. We now look at that. I'm looking at the character of the individual who's running that company, what they stand for. I'm getting a lot of referrals and references from folks that they're working with currently.
Are you the big fish in a small pond, in a small management company's pond? Or are you this?
I've had both experiences. We've used national firms that have hundreds of thousands of units in Waco when we were 100 units out of 100,000. So we were the smallest fish in their pond. In Des Moines, we were 600 of 1,500. So I would say that's a pretty big fish,
for 40% of their business.
Company.
Yeah.
Correct. And in that case, we have a manager who, great ethics, great people, tried their best, The reality was they just didn't have the systems and the experience to continue to scale up. They were running it great at 600, they were running great at 1,000, but as turnover happened, the doors continued to stack up. They didn't have the underlying systems and automation and talent development to run a larger portfolio, is really what we've run into.
So how do you pick the new one? Do you interview three firms?
Yep.
Do you-
Constantly at this point, I'm just constantly keeping my options open. And the I have a mentor that says you should always have a pocket offer, whether that's, your career, you're working at this company, you should always have an offer or two from somewhere else that you can move to. And I feel the same way. I'm riding this pony and I'm going with this company, but I always have two in the wings who have my T12. They have who I am, they know what I'm looking for, and they want the business. And if any day I called, it wouldn't be a re-interview or a dating process. It would be like, it's go time. I'm ready to move. And that's what
Hit
we've
the
done.
running.
Yep.
Okay.
Yep.
Got it. So you're thinking about being vertically integrated.
Yep.
What are the pros and cons? You and I and your partner, Greg, we've had a couple of discussions now.
Yep.
You're in that journey. What are you thinking about?
Yeah. I think the draw toward it, because we've spent so much time and energy on asset management and optimizing our portfolio, there are days and times where I say, well, I could do this, or I'd do this better than they could, right? Now that I know what I know, well, goodness, I could do this better. That's the phrase. I could do this better. On the con of it is I'm a dad, I'm a husband, I'm a community member. I want to continue to buy new deals. I want to continue. I love raising capital. A lot of people don't like that. I love working with investors. I love having 5, 10 coffees a week. I love going to conferences and meeting new family offices. It's just fun for me. And that's rare, but so I want the energy to raise capital, do deals, coach my kids' sports practice, and have dinner with my wife every night. And the part about being a sponsor, let's take the vertically integrated out, is that that's asynchronous work. I just got to get it done this week or this month, right? I just got to find a new family office this year. It doesn't matter if it's Tuesday or next week or next month. Property management, that's potentially day by day, hour by hour process.
It's full-time job, man.
I literally had today, I mean, you couldn't make this up. I had the electricity, some bus bar blew on one of my buildings. So I have 16 tenants with no power right now. My involvement was an email that goes, "Oh, bummer. Let's talk about the capital expense to fix that." Meanwhile, there are 5 or 6 people who rushed on site. They're moving people out, changing out units, putting up temporary, whatever moving people to hotels. I mean, it's a triage moment, right? That is the part that pulls me back from managing the business, because it's potentially 24/7.
Yeah. So, and we see that. I mean, I share this with everybody that'll listen. When people are thinking about managing their own business,
Yeah.
we tell people we sign up probably 12 companies a year that want to do that.
Okay.
And within a year, half of those
You
say,
shared that.
oops, I made a mistake. I don't want to be in that business for the very reasons that you just articulated. So thank you.
Cool.
So now let's talk about, what advice would you give to somebody that was in your shoes 5 years ago, right? You only had a few small passive income investments.
Yep. Yep.
What advice would you give them now? What's the best way to start so they don't have all the headaches that you had?
Yeah, I think for sure my obsession has become around de-risking our deals. And I think there's no better way to de-risk a deal than to get a low basis, pay less than its inherent value, and to put conservative debt. Those two things are hard to do. One, because there's a lot of people looking for these properties. So you've got to be in the market and very disciplined in your underwriting, not getting, drunk on rent assumptions and what could happen. No, you got to think about like worst case. What if it's 80% occupied? What if cap rates expand dramatically? What if, I don't know, the federal government increases interest rates 25 times X? I mean, Mike, it was 0.2. It's now 5.3, or I guess it's come down a bit, but 25 times bigger than like that. That's impossible. That couldn't have happened. Well, it happened to us, right? So that's for one. I lost my train of thought. It was
what advice would you give to somebody starting out?
Okay, and the other one is conservative leverage. Please keep your leverage at 65% or lower. And the challenge with that is that means you've got to bring a lot of equity to the deal. So when you're starting off, you want to, and all the books and all the Instagrammers are going to tell you, oh, I do this for no money down or as little money down as possible. Sure, that's possible, but it's also embedding a huge
Very
amount of
risky.
risk,
Yeah.
massive amounts of risk. Because here you go, I know folks that have gone belly up on a deal. They put 80% leverage on a deal in Phoenix, Arizona, and because of what's happened, the asset's gone down 25%. They're out of money. Like they're underwater. The bank is going to take the property back. All the equity's gone. If they had gone to 65 leverage, there'd still be a tranche left. They'd still be able to talk to a bank. They'd still be able to refinance. It wouldn't be comfortable, but they'd hold on to the building. Because the leverage was so high, they're out already. So get a low basis, conservative leverage, and also like start small. I mean, luck, 96 was a pretty big deal to start with. And then of course we went to a 216 unit portfolio right after that. It was fun going big, but best practice, I would say start small. Buy a 15 unit,
Great.
buy a 20 unit because you're gonna make mistakes. So let the mistakes happen here, learn the lessons, then go buy a 100 unit, 200 unit.
Great, great. One of the other questions I had was when you raise more money, when you're only financing 65% of a deal, you have to raise more money. That lowers returns.
It
What kind
does.
of returns are you promising to your investors?
So our deals have underwritten right about a 15 IRR, but more importantly, we manage to a yield on cost. So I look to get an 8.5% yield on cost by year 5. Now that doesn't tell you how much money you're going to make, but that's the underwriting standard. So
Mhm.
with that, that equates into an equity multiple of around 2 over 5 years, 2x over 5 years, a 15, 16 IRR. And then I'm obsessed with cash flow. I don't want to hold on to a building and then have a big pop when I sell it. That doesn't sound exciting to me. I want to have income every month, every quarter. So cash on cash for our deals end up at 6 to 7% range.
Great. And that's where the more that I'm seeing the guys that are kind of the slow and steady, quickly, but over time exponentially grow.
Yep.
They're the ones that under promise, over deliver. They're looking at a 14 to 16% IRR to their investors and about, like you said, a 6% or better cash on cash return.
And one of
Actually,
the
I'm seeing even 4% cash on
Oh,
cash.
absolutely. And I'll say our underwriting model states significantly more than that before we go to publish it, right? So what I'm seeing in my heart, I'm like, this is probably an 18 and way over a 2,
Okay.
right? But then in those weeks before we're finishing our DD and launching the deal to an investor, we trim down cap rates or we trim up cap rates, we trim down rents, we increase the
Yeah.
expenses a
Add
bit so that
expenses,
yeah,
exactly.
so it ends up in that because we've realized most retail investors, they don't know a 14 versus a 17. It doesn't make any difference. So publish a 14 and go hit a 17. Everyone will be a lot happier than the reverse.
Absolutely, absolutely.
Yeah.
So thinking about where we are in this marketplace, the
Hmm.
Fed just dropped rates, but the
Yep.
10-year Treasury kind of went up a little bit, right?
Correct. Yep.
And that's the 10-year Treasury is more indicative of what loan rates are going to be than the Fed
Massively
rate
so.
is. So
Yep.
what is your take on when does the market turn? When do you think, I don't think we're ever going to get back to 3% mortgages anytime in the
Not
next
anytime
5 or 10
soon.
years. Yeah.
Right. Right.
So what's your take on the next year, the next 3 years?
So I'll start to say that real estate is highly localized. So I'm in two markets that are experiencing completely different dynamics. Des Moines was a sleepy Midwest town when we showed up. No institutions were around. Cap rates were 6.5, 7%. Since we've entered, they just had the largest transaction in the state of Iowa's history, $200+ million bought by an institution at a mid 5 cap. So that market is actually seeing increases in value and competition and capital inflows. Jacksonville, Florida is, I believe, in the absolute dumpster. I mean, it is asset values for vintage product, 70s, 80s product is down 30 to 40% from where it was off of the peak. 160K a door. I just put an offer, literally a deal that traded 160K a door. I just offered $75,000 for that, and I'm not getting laughed out of the room, right? So highly
Wow.
localized. I just want to be clear about that. So I struggle with the like, where's the market going? I can comment on the economy, right? I think it's highly challenged. I think there's a lot of threats out there. I think the tariffs and the uncertainty and the jobless claims, those are scary things. I think inflation's a real threat. But I also will say, here's why I might be a little contrarian as it might be. I've studied history and economics, and what I found is that when things get into real trouble, a developed economy like the United States, they print money and they do quantitative easing. So oddly enough, if we hit a total disaster, the government's going to bail everybody out. They're going to drop rates to crazy low and they're going to print money out. And in that situation, I want to be owning hard assets. That's the one thing that does really well in that environment, right?
Mhm.
I actually am more concerned about this like teeter-totter middle ground, just float around for a couple of years. Because Mike, you're right. Then we are going to live in this 5-6% interest rate range. We're not going to see cap rate compression, and things are just going to wah 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 wah. So I think it's going to be somewhere in between the two. It's going to just kind of flatline and stay in there, or there's going to be total chaos, and the government's going to bail everybody out like they've done multiple times and since I've been alive.
Yep. Okay. So books are one of the keys to success, of the people that I see do the best. They try to stay up on different things. What book or books would you recommend to an entrepreneur, to your younger self, or let's say I've got 20 something boys that want to be in the business.
Sure.
What would you tell them?
I am a avid reader, so I'm gonna forget more books than I can think of right now. But I do have, first of all, I'm gonna do a little self-promotion. I read your question sheet. So Ready, Set, Invest. This is a book that I published, my journey, and it is the exact book that I wanted to have 5 years ago. It takes you through the mindset of a potential investor, auditing your relationship with money and work. It then prepares you for what private investing and real estate investing, different than public markets and securities, and then actually gets into the like underwriting and vetting out a deal, raising capital, and getting it done. So if you want to run on my journey, I would suggest Ready, Set,
Great.
Invest.
So here's the thing to the first 8 of our podcast listeners.
Yeah,
You send us an email, we'll send it out to you for free.
I
So
love it.
take
I
that.
love it.
So
Fantastic. Also, here's another book that I have on my desk. Unfortunately, you can't read the title here, but it's called The Science of Getting Rich. It was written in 1920, I believe,
oh wow.
and it's a classic mindset book. There's very little actual strategy there. It's just the mindset of abundance and believing that like abundance is coming to me at all times, and I'm going to stay in that mindset every day, every minute of every day. Things are good. The world's conspiring for my benefit, and I'm here to do good, and the world's here to do good for me. And I stay in that mindset. I've read this book hundreds of times, and the moment doubt creeps into my mind for a split second, I go right back, read a few pages, and I get right back to being an abundant mindset.
Where you need to be. Great.
Yep.
Well, thank you very much for your time and for your
Absolutely.
advice. We're excited to have you. Our podcast listeners, I'm sure, are going to appreciate it. So we're glad to have you. Thank you very much. And again, want to thank our sponsor, Ascent Multifamily Accounting, for hosting these podcasts, and for Reilly Driggs for helping coordinate the production of them. And want to thank you all again, and we'll see you next time.
Thank you, Mike. See ya.
Thank you to Ascent Multifamily Accounting for making this podcast possible. Ascent has a team of multifamily accounting experts that provide outsourced bookkeeping for multifamily management companies. To learn more about Ascent Multifamily Accounting, go to multifamilyaccounting.com. We hope you have enjoyed listening to the Multifamily Excellence podcast. If you want to hear more from multifamily experts like this, you can find our podcast on Apple Podcasts and YouTube. We appreciate your support and can't wait to have you join us again for our next episode. Until then, take care.